Hey everyone, welcome back to Yuri's Box. In this video I'm going to talk about TLT, the 30-year bond, possible news failure. If you like this kind of content, consider leaving a like, and as usual, nothing in this video is financial advice. So I said thank you to everyone that subscribed, as liking my videos and commenting on my videos in the video before, but I just want to take a moment and thank everyone again for the interactions. I deeply appreciate them. I'll get straight to the point of the video. So today was kind of a funky day, if you ask me. Basically, on Sunday, I highlighted really what would really be the highlights of the week, okay? And for the week ahead, I envisioned there being two checkpoints, being checkpoint number one, futures opening, and we kind of failed that because we didn't get any comforting news. The weekend was rather quiet. On the contrary, Trump came out and during talking with the press, he just reiterated more of the same. Basically, he was asked, what do you think about the market crashing? And he said, well, I don't want the market to crash, but sometimes the market has to take its medicine. That, of course, fueled things like, the futures. Take the S&P 500 futures, for example. We were deeply negative. All right. We opened at around, we got down to 5.2%, which wasn't great. All right. So we failed checkpoint number one. Checkpoint number two for this week is April 9th. And what I'm expecting, or really wasn't what I was expecting, is that as we move towards April 9th, I would expect there to be more movement, meaning, possible negotiation, possible, hinting at, I want this, I want that, again, trying to come up with something constructive. And today was kind of a messy day, if you ask me. We started off, going back to the weekend, we had hints that perhaps the EU was about to retaliate. On the contrary, today we saw some constructive talk, meaning that the EU was hinting at a possible 0-for-0 tariff negotiation, which helped soothe many market fears. And mainly the way you can visualize that is in the 2-year yield. Wherever the 2-year yield goes, the Fed usually follows suit. All right, the 2-year is more or less where what the Fed follows. All right, there is a fairly nice correlation between the 2-year yield and the Fed funds rate. All right, so again, we were pricing in. Current Fed funds rate is at 4.25. Well, effective is at 4.33, and this was basically 100 basis points of rate cuts down here. However, today we quickly reversed, and we're back up at 377. The same kind of move we saw across the curve, and I think that most of it, as I said in today's video, was due to a few things, honestly. Point number one, when you're down 20%, say on stocks, all right, take the Nasdaq. Just ignoring today's price action. When you're down 22%, you sell what you can, and you sell some of your winners. This is something that I've pointed out with gold. All right. Was it a good day for gold today? Absolutely not. Has it been a good few days for gold? Absolutely not. From the peak to here, we're well over 6.5% down on gold, right, in a matter of 3 days. And again, one good reason is that when there is stress, you sell some of your winners, and gold has been a winner so far. Same thing can be said, in my opinion, for something like bonds. Ever since really the beginning of January, bonds have outperformed stocks. All right, they are part of the very few winners. And if you're forced to raise cash, well, perhaps you'll sell some of your bonds. Second thing that fueled potentially the sell-off that we saw in bonds is some of the optimism, again, that was highlighted today. The EU possibly hinting at 0 for 0 tariffs. We didn't really get much talk of further retaliation from the EU. Again, today, for the most part, we saw constructive talk. Until that is, I'd say about well, really not mid-trading, just after the open, when we saw the news circulate that that the US really was considering postponing any potential tariffs except China. The S&P 500 rallied, quickly sold off, and generally drifted up higher. All right. Trump spoke again, and the rest of the day was pretty uneventful, but it kind of helped soothe overall the fact that perhaps things aren't going to end up, with the worst case scenario. And the reason why I titled this video is Possible News Failure is because of this tweet right here. This afternoon, Trump announced the possibility of having, on top of the tariffs that are already potentially going to be in place on April 9th, if China doesn't withdraw its 34% increase, so it's 34% retaliation tariff, the US will increase and will impose another 50% tariff on China. All right. Now, this comes back to something I was, well, I don't want to say warned, but I was talking about I've been talking about over the weekend. Just because something sounds really ridiculous, and April 2nd really should have taught us this, doesn't make it impossible. Because after we had this tweet, the markets really didn't care that much. Especially bonds. Given that bonds sold off as if really a 20 basis point move on the curve is, hard to ignore. And it was nearly as though we had a significant breakthrough on tariffs. But today we really didn't get a significant move forward on tariffs. Now, I'm not saying we can't get it. I'm the first one to say that things can move extremely fast. What I'm saying is that we moved as if we have risk on back, meaning that the tariff fears are all gone, when in fact we had potentially even worse news. And again, I find it curious that kind of the market is going, challenging something that, again, it's not me trying to be, the world revolves around me, absolutely not. But I'm just pointing out the fact that just because something sounds ridiculous doesn't mean it can't happen. If, you had a time machine and you went back and you told your yourself, your two in March, that Trump would have imposed the tariffs or thought about imposing the tariffs that he proposed on April 2nd, would you have believed that? I'd say no. Can this happen? A total of 104% tariff on China? I mean, it sounds ridiculous. Does that make it impossible? Not really. It could happen. It could happen. And I think that what we saw in bonds today is really just shrugging it off completely. Like, it's something so ridiculous that it's not going to happen. And again, it very well might not happen in the end. All right. We'll be here on April 10th, and we'll be back to risk on, and we'll have to deal with the aftermath of the tariff talk. I would not jump to conclusions. That's all I'm saying. I would not try to extrapolate things too much. I would maintain my cautious approach to things and wait. Because if April 2nd has taught us anything, is again, just because something sounds ridiculous doesn't make it impossible. All right. And so far, we have also seen, the administration point towards being really going in the same direction for the most part. Now, you do have some cracks here and there, of course. You saw Elon Musk speculations here and there, Scott Bessent speculations here and there. But when they speak to the press, they're all saying more or less the same thing. All right. Again, this can all be over in a matter of seconds. It can be over with a tweet, all right, with a post on Truth Social. But I wouldn't discount things just because they sound ridiculous. Because again, that's what April 2nd shows us. All right. So could today's Trump announcement be a news failure? Meaning that this should have, pushed potentially bond yields lower. Instead, we saw yields pop higher. It could very well be, and it could very well be the beginning or first signal potentially of perhaps the market looking through the tariffs. I'd still be on the cautious side of that, simply because again, it sounds ridiculous, but just because it sounds ridiculous doesn't make it impossible. And for really the second part of the video, I'll point something else out. I'll go back to something that I've been talking about, which is the parallel with 2008, all right, the 06-08 cycle. Now, again, as I've been saying in my previous videos before, you comment or you think I'm advocating for canned tuna and the end of the world. I'm absolutely not saying that we are in 2008. I'm personally waiting for this correlation to kind of deviate at a certain point, all right? But I've been looking at this ever since November, and I've started making my videos really when we were about here, about the 06-08 comparison. So what I'm saying is don't shoot the messenger. Like, I'm just pointing things out. So, again, if you haven't watched my previous videos, the idea is you have a first rise then followed by yields declining. If you look at what happened after the bottom in 2020, rise in yields, decline in yields, followed by a significant rally with some noise in between, which is what we saw right here. Significant rise with some noise in between, followed by sideways action. Rally, sideways action. After that, boom, breakout. Yields form the first top right here. And what follows is this kind of W formation, shark pattern. Again, call it whatever you want to call it. Sure enough, this is what we have here, the famous W. And I speculated that if we were to draw a parallel to 2007 at this point, I speculated that we were right here. After the first decline in yields, then yields falling below the bull market support band and trying to pop above the bull market support band, which is what we got right here. Let me put this on a weekly. That's why. All right. So first decline, go below the bull market support band, poke your head up above the bull market support band and get rejected and continue lower. Now, what we saw after that is potentially something similar. All right. Significant rise in yields, and this move right here, for example, was a 30 basis point move. All right. Now, I've pointed out many times that these two moves aren't exactly the same. You see differences in the two tops and the two bottoms right here. They're exactly the opposite. All right, so first top was, in this case, higher than the second one, and the first low was higher than the second one. Okay. I don't expect this to play out exactly the same if it actually does. And in fact, if this move continues above, we're back at 485, for example, then that'll be the end of it, and we can definitely this hopefully this honestly bad comparison. If the implications of the comparison aren't too bullish to say the least. But really, this point of the video, I want to make one thing clear. What makes the parallel, in my opinion, relevant between what we saw right here from 07 to 08 and what we're seeing right now, and what we've really been seeing throughout the cycle, is what I call, it's the inflation narrative, okay? What we have this time around is what I call, again, inflation PTSD. The bias so far is for rates to move higher because we have come off of 2022, which has been one of the worst inflation spikes that we have had to live through. And so we still are looking for reasons for rates to move up. And why does that make the comparison relevant? Because just like we have inflation PTSD right now, in 2007 and 2008, there wasn't a case of inflation PTSD. There was a case of inflation, all right? Forget about, disinflation. As the 2008 recession materialized, inflation was not cooperating. We had inflation move up significantly. And in fact, this is where Bear Stearns collapsed, March of 2008. What followed that was an increase from 4% on headline inflation to 5.6% on inflation. Keep in mind, this is July of 2008, 2 months before the collapse of Lehman Brothers. All right? And at this point, okay, right here, in this time frame right here, this is a fairly healthy exercise. Go back and look, Washington Post, Financial Times, whatever, pick your poison and look at what they were saying if you're even more curious, go and look and see what the Fed minutes, what the Fed was talking about back then. Inflation was number one priority, all right? And in fact, the Fed lowered rates in January of 2008 by something like 200 basis points. I mean, a lot. And what followed that was a rise in inflation. And by the time we had 5.6 on inflation, people were yelling that we had to rise, that central banks had to increase rates because we had inflation. All right. Now, again, what followed after that was deflation. All right. All of this to say that what makes this comparison relevant, in my opinion, isn't that we're going to follow this, blueprint to the letter. I mean, we could very easily be, replicating September of 2007 right here with this kind of move. But it's just to point out the fact that like today, like 2007, 2008, we have the same narrative around inflation, the same bias with rates, meaning they have to go higher. And in fact, the move that we're seeing right now, and potentially even the move that we saw previously from this low right here to the local top so far, was a 33 basis point move. This alone, what we saw today, was a 21 basis point move on the 30-year yield. I pointed this out in today's video. We had numerous spikes in yields, 33 basis points, 39 basis points, 48 basis points. And this one right here, which was probably the worst one, well, worst or best, depending if you're long or short, 63 basis points. Okay. Narratives, I mean, the catalysts might be different. Every cycle has its own, its defining features and characteristics. What I'm saying is that we like to think that we're unique, but at the end of the day, we're really not. History has a funny way of reminding us that we're not unique, and that, yes, the things that have caused things in the past might be different. We might not be dealing with them today. But the things we're living through today aren't completely unique as far as history is concerned. Now, what should we do with all of this? All of this to say is that, first of all, I'm waiting for this comparison really to finish. I'm waiting for it to deviate, okay? But really, the main focus of all of this is that try to maintain a cautious approach, okay? Because it is eerily similar. And while we might not have Lehman Brothers and Bear Stearns and all that good stuff, we do have things that are lingering still today, even with, this quasi-constructive day that we had. There are still issues. And until those issues aren't resolved, which again could easily get resolved tomorrow with a post on Truth Social. That is really the irony of all of this. Everything that has transpired ever since April 2nd, even really before that too, can stop in a matter of seconds with a tweet, with a post. I could be making this video right now. Trump could be posting something, and it could be all over. All right. So to close off the video, don't fall for doom posting. Number one. If you're long equities and, or you hold stocks, or if you hold bonds, try not to fall for each asset class has its own doom posting, all right? Try to ignore it and try to look at what is happening. Because again, as I've said many, many times, as long as we have tariffs, fiscal tightening, and some the cherry on top being the yen carry trade, as long as these issues aren't really resolved, they'll continue to bug the market. All right. So again, these are weird times, during which I think it pays a lot to have a cautious approach. Try not to get too excited about things, because April 9th will tell you, and really the lead up to April 9th will tell you where everything is headed. If everything gets resolved, which again, as ridiculous as it sounds, could easily happen, and therefore a lot of the risk off for the moment gets a setback, honestly. Although you'd still have to consider the second effects, what tariffs have caused. You have injected, whether you like it or not, some degree of uncertainty into the economy, which alone is enough to block potential economic activity. But again, if everything gets resolved, we'll deal with that later. But for the time being, we're still dealing with everything that where we left off on Friday. Nothing's really changed. Potentially, the only thing that seems that you could argue for is that China it's becoming clearer and clearer that China is the real target here. And I've said many, many times that, yes, China is the target, but the focus of this is try to get the EU on the same page as the US so that they can go together against China. All right. So China's the main objective, but right now what is at hand is try to get the EU on the same page as the US so that they can potentially go hand in hand against, at least economically, the so-called China problem. I'll leave it at that. I'll continue to look for as long as it holds, really, the comparison with 06-08, because I do think that there are some similarities between today and 06-08, mainly the inflation narrative, right? We have inflation PTSD. They had inflation, right? Back then, they had inflation. And they were continuously looking for a reason for rates to go up, So similar to what we're seeing today, in this last year or so. So I'll continue to monitor things. Try not to get too emotional, not fall for doom posting, whether you're reading doom posting about bonds or stocks or gold, whatever, even Bitcoin. There's a lot of doom posting for every asset class, really. I'll leave it at that. If you like this kind of video, consider leaving a like, and I'll see you next time. Bye.